Hi, my name is Toby and I'm a manager at Pear Limited Company. We manufacture and sell phone cases to companies all over the world. Me and my colleagues were given the task to try and improve the performance of the business, and so we decided to analyse our performance over the last 2 years. This is our agenda for today, and I will now hand you over to Nicole, who will take you over the finances.
Hi, I'm Nicole. These are the important parts of our income statement, and we did profitability ratios, and we did the operation profit margin and the gross profit margin. Now I'm looking at the gross profit margin. It went higher and higher up till the third quarter, and in the fourth quarter it dropped a bit. However, in the fifth quarter it dropped significantly, and this was due to the high spending on marketing, operations and research and development. And in the sixth quarter, this was also the same, due to high spending in operations, management, marketing and research and development. However, we realised our mistake, and in the seventh quarter we picked up again, but in the eighth quarter we were a bit desperate and spent way too much on operations and we didn't sell as much. Looking at our balance sheet, the efficiency of the company is quite bad because our average inventory's turnover period is really high. Although it does get lower as time goes on, it's still too high, and this is because of our high accounts receivables. And as you can see in the sixth quarter, it was 88,000, and the reason why we have our accounts receivables being this high is because we manufacture to big retail companies and they buy in bulk, so they don't pay back fast enough. And this shows for our average settlement period for the trade receivables, which is still up to 105 days, 118 days as time goes on. However, because of our high accounts receivables, the liquidity of a company is very high. The current ratio and asset test ratio show that our total assets compared to our total liabilities are 14 times. However, this may not be too good because we don't actually have the cash in hand. We have the cash with our accounts receivables. Looking at the cash flow forecast, our cash went higher and higher as time went on. However, in the fifth period, our cash dropped drastically to £25,532, and this was due to a low net income and higher accounts receivables. And this continued on for the next 2 periods. But by the 8th period, we realised our mistake and stopped spending so much on investments in PP&E, and our cash rose to £19,745. To conclude, the strengths of the business were that the cost of goods sold were always low in comparison to the amount we sold, so we always made a profit. The liquidity was high, and we never ever made a loss, which was great. However, our weaknesses were the excessive spending on operations, marketing, research and development, and PP&E, which caused the low cash in hand, and also our reliance on trade receivables and a generous payback period, and this can be done by making them pay back faster. And we also had excessive inventories, which links back to our trade receivables. Now over to Charlotte, who's doing the marketing.
Hi, I'm Charlotte. I'm the marketing manager for Pear. I'm going to talk you through our marketing expenditure, why we decided to spend when we did and what we did. So at first we invested quite a lot in marketing with the belief that if we spent more on it, that we would be more able to meet the needs of the consumer, and this would result in repeat purchases and customer loyalty. But at this point here, what we actually found was that other groups weren't spending as much on marketing, but they were performing better than we were. So at that point we decided to decrease our market expenditure, and then towards the end, in like a desperate bid to climb up the league table, we began reinvesting in marketing. What we actually found when we compared our marketing expenditure with the net income that we were receiving, we found that there wasn't really much of a correlation, but what we did find was that these points where the two lines overlap, that we were actually marketing unproductively because we were spending as much on marketing as we were on net income. So the strengths of our marketing department were that we made informed decisions, as I said earlier, at the point where we realised that other groups weren't spending as much, we also stopped spending as much. But there were weaknesses, and we would aim to improve these if we were to repeat the process again. So we really should have spotted this trend earlier on, and even more so we shouldn't have ignored it like we did towards the end. Also, the figures that were used to generate this graph were only taken from the beginning and the end of each trading period, whereas there may have been fluctuations between the periods. It's also analysed out of context. There's nothing to say that only marketing would have affected net income, and overall we were quite unproductive with the marketing. So I'm going to hand you over to our Human Resources Manager, Hugh.
Hi, this is Hugh from Human Resources Department. This line represents the amount of new shares issued to employees per period. We decided to issue more shares because our research found that employee ownership can improve company performance. From period 5 to 7, we issued fewer shares to employees because we did not want to lose our control. First, it seemed like there was definite positive correlation between the number of new shares to issue to employees and net income. However, this doesn't seem apparent in the later period, where number of new shares remained the same per month, but net income fluctuated. The biggest strength was that we made informed decision. However, we assumed that there was direct link between the number of new shares issued to employees per month and net income, but that may not often the case. Now I'm going to hand it over to our R&D manager, Michael.
Hi, this is R&D manager Michael. We invested a lot on R&D in the beginning to improve our product's performance. However, we realized that our competitors actually invest lower on R&D compared to Pear Ltd, but receive higher return, and this is why we decided to put less effort on R&D. Investing on R&D brought us raising of net income. However, as I mentioned from the previous slide, we put too much cash on it. Third, in period 7, as you can see from the graph, we decreased investing money, and in result, it brought dramatic raising of the net income. The strength was we could improve product quality, which related to our net income. For the weaknesses, firstly, spend too much money on it. Secondly, we could not follow the trend, which is we couldn't steadily investing money on the R&D. And lastly, we faced a situation of insufficient cash. Now I'm passing this back to Toby, and let's see what's the conclusion of Pear Ltd.
To conclude, our strengths were that we made informed decisions, but our weaknesses were that we measured performance by net income exclusively, also that we considered each department exclusively, and finally that we relied too heavily on our theories and ignored obvious trends. Thank you very much for listening to our presentation.